Welcome to Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, located in Phoenixville, Pennsylvania. We're a boutique wealth management firm providing trusted advice to individuals, families, and businesses for over 20 years. I'd like to welcome my co-host and Robin Bond of Transition Strategies, LLC, a team of tenacious lawyers effectively representing their clients at every stage of the employment relationship. Transition Strategies is not affiliated with Hepburn Financial Advisors or Cetera Advisors. How you doing, Robin?
Good, Doug. Great to be back with you today.
Great to be with you. I heard there were some, we have some changes coming up in the new year regarding non-compete agreements in the medical space. Can you tell us about that?
Yes. In fact, I just had it this week with a physician getting an employment contract that the healthcare system was trying to date it for November of 2024. And I said, no, wait a minute. Under this new law in Pennsylvania, it's called the Fair Contracting for Healthcare Practitioners Act. Any employment contract that goes into effect 1/1/25 or after limits the enforcement of non-competes. In fact, if the healthcare system lets you go, voluntarily, they just let you go, the non-compete won't be enforced, which is huge for healthcare practitioners. And if the non-compete is only 1 year or less in duration and the doctor voluntarily quits, well, then it can be enforced. But this is very helpful if you are involuntarily terminated and lose your job. You're not prevented from going and competing. So, when I was a hospital lawyer, I used to say that public interest is really not served by preventing doctors from practicing for any reason.
Right. No, that makes
so I think the public interest is going to be very well served with this new law.
Yeah, that makes a lot of sense, and I agree with you. In other news, a lot of people have been talking about, and you may appreciate this, the Corporate Transparency Act.
Tell us about that. Yeah.
We've been told over the past year that to reduce fraud and in financial transactions, that every corporation has to report who their owners are to this international board, and the U.S. District Court for the Eastern District of Texas has issued a preliminary injunction nationwide. This was supposed to go into effect January 1, 2024. It got deferred and delayed until January 1, 2025. And so a lot of people have been trying to comply with this and get their stuff filed before December 31, because the fines were really high. It was up at like $600 a day, and over $10,000. So it was significant. So business owners have a reprieve right now. They don't have to tell who owns the company. And this is principally for partnerships, LLCs, S corporations, not publicly traded companies. There are certain exemptions, and or governmental agencies, not for profit. So there's a whole list, about 23 exemptions. But the good news is, people can breathe a sigh of relief that they don't have to disclose the owners of the LLC that owns their retirement home down in Avalon. So that's good news.
Good. It saves me a little bit of money. I was just talking to my CPA today to do that filing. So thank you. Yeah.
I think a lot of people are going to be very appreciative of that. Just wanted to check in. We get all kinds of mail from our viewers, and we got a viewer question from Raymond Lamano of Philadelphia. Can an employer tell you who you can be friends with outside of the workplace? I think this sounds like, maybe workplace romance question.
Sounds like a question for the employment lawyer, right?
Yes.
The answer, like all lawyers, well, it depends, right?
Right.
You'd be surprised. Employers do have the ability to extend their tentacles far beyond what happens just within the workplace. I'm not sure what Raymond's exact question is. Does he want to have a political association? Does he want to have that kind of association, or more of a personal association? So some companies have what they call anti-nepotism or anti-fraternization policies that do limit your ability to be friends with people outside the workplace. And a lot of this is designed to prevent romantic relationships within the chain of command, because if there are romantic relationships inside within the chain of command, that leads to discrimination and sexual harassment claims, and that has very much been permitted. So if you think, well, I want to hit on my coworker, as long as I don't do it in the workplace, I'm fine. The answer to that is no, you're really not. Because if you harass them with emails or text messages or in-person conduct that is offensive, the employer policies generally do extend to cover that kind of misconduct. They can discipline you or even terminate you for that. And if you are going to have a romantic relationship with someone, some companies require you to disclose that to human resources and sign the equivalent of what's called a love contract, saying you
Wow.
parties are voluntarily entering into the relationship. Nobody has coerced or forced the other into the relationship. So, and again, this is all done to protect employers against lawsuits. Pennsylvania doesn't have any statute that protects you for political associations. Like if your concern is, well, I want to be politically active, can my employer take action against me for that? And in Pennsylvania, the answer is pretty much yes, they can. So, but that's not universally the answer. There are certain privacy laws, constitutional protections on a state-by-state basis that could apply. Hope that was helpful, Raymond.
Yeah, thanks for sending that in, Raymond. If you'd like to get your questions answered on Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Well, as we're approaching the end of the year, I don't know about you, but I'm getting emails from my tax advisors, my financial advisors saying, hey, let's look at some tax strategies. So I think it's great if we can talk to Doug, our financial advisor expert here, and see if he can help all our viewers today with some steps and strategies for year-end tax savings. So Doug, you're on the platform today.
Oh, thanks, Robin. Well, first,
Yeah,
I'd like to there's a lot of things that we could talk about. I mean, we could probably fill a 2-hour show, but one thing we need to make sure of up front is that everybody knows that this is really educational in nature. Obviously, everybody's situation is going to be different, so they're not specific recommendations to you. Be sure to talk to your team of advisors, your accountant, your financial advisor, your attorney, to make sure that whatever you're considering doing before the end of the year makes sense for you, and you've had a chance to evaluate it based on it from a cost benefit standpoint, because everything does have a trade-off. So yeah, there's a lot of things we can do, and for many years, the mantra has always been to defer income and accelerate deductions, and the reason for that is tax rates have been coming down for decades. Back in the 60s, we had tax rates as high as 70%, even 90%. And then, with the Tax Act of 86, they came down even further. And even further in 2017 with the Tax Cuts and Jobs Act. So people have always tried to defer income, hopefully into a future year when tax rates are going to be down, and accelerate deductions into the current year so that they can reduce their taxes as low as possible. But there are concerns now with the federal debt and the deficit getting as large as it is that tax rates may actually go up. So I don't know that that mantra is going to hold, but it's still there still are opportunities to take advantage. I think what you got to do is you got to time your decisions properly based on the facts on the ground, your specific circumstances, and what the tax code looks like and particular tax rates. I can tell you that, depending on your situation, it's probably going to be a little bit different. Obviously, business owners have a greater opportunity for tax deductions than, say, an executive or somebody who's employed at a company or a retiree. But I think there are plenty of options available out there for people to try and accelerate those deductions into this year and make sure that they pay the least amount of tax.
Can you tell us a little bit about harvesting losses? Because I always hear about this, and I think it would be helpful if you talk about that strategy. And for example, is that a dollar for dollar offset against taxes, or how does it work when you harvest a loss?
That's a great question. And a lot of people might be saying to themselves, gosh, how can I harvest losses when the market's gone up as much as it has over the last year? Believe it or not, I've run across prospects recently that still have positions in their portfolio that are below cost. So, when you buy a security and that security goes up in value, and you haven't sold it, you have an unrealized gain. When you buy a security and that security goes down and you haven't sold it, you have an unrealized loss. And so what the tax code says is that you have the ability to take those, realize those losses and offset those against capital gains. So you can offset the loss against the gain to net them out. If you have $3,000 in capital losses and $3,000 in capital gains, they'll offset each other. But if you have $6,000 in capital losses and $3,000 in capital gains, that extra $3,000 can be used to offset ordinary income. That can be a powerful tool depending on your tax bracket.
Oh yeah, sounds like it. And can you carry that forward? Like if you have more losses than you can use in 1 year?
Absolutely. So we talked briefly about the offset of capital losses and capital gains, and the ability to take some capital losses against your ordinary income. That's limited to $3,000 that you can use to offset ordinary income. Anything over and above that you don't get to use, you get to carry that forward indefinitely.
Oh,
So
that's great.
that's there are many situations where people may have had major losses. And this was evident after the Bernie Madoff scandal in 2008. People had huge losses. They got the ability to take those losses in the year in which they occurred and carry over any losses. There were some special rules surrounding the Bernie Madoff situation, but there are times when, in huge market declines, when people experience losses, that they may exceed that $3,000. But so yes, you can carry those forward. And if tax rates go up or your income goes up, then that's a greater benefit. If it goes down, then it's not going to be as great a benefit.
No. Speaking of benefits enrollments periods just ended probably for most people. And that involves typically, 401k and your contributions or healthcare benefit plans. Can we talk a little bit about those benefits and how you can utilize them for tax saving strategies, Doug?
Yeah, that's a good one. With a lot of our clients, business owners, as well as executives, employees, one of the things we try and do is review their benefits at the end of the year in the fourth quarter, so that we can make sure they're making smart choices about their money. The first option, if you haven't maxed out your 401k, now's the time to do it. There may be anywhere from 1 to 3 paychecks left in the end of the year. Depending on your plan provisions, you could potentially again, potentially based on your plan document, defer up to 100% of your compensation. So if you don't need the money and you want it, and you still have a lot of room left before you hit your max, you may be able to put your paychecks in there. But again, it's a trade-off. How much money do you need to live until January 1? And how much money do you need to get into your plan? Well, if you're under age 50, the deferral for 401ks is $23,000. And if you're over 50, you could do $7,500 in addition to that as a catch up. Next year, though, in January, beginning January 1, the base is gonna go up to 23.5. So people may want to make adjustments in January to make sure that they capture as much of that as possible.
Wow, yeah. That's good. And then, so if I'm limited to 23,000 right now, but I'm over 50, so I could put 30,500 in. Is that every year I can do that, or?
Yeah. Yes.
Yeah.
Yes. As long as you're over age 50 and you've put that first 23,000 in.
Wow.
So, sock it away while you can. Obviously, this was done to benefit baby boomers who, unfortunately have not saved enough for retirement. Because a lot of statistics kind of show that. And
Finally get the kids through college. Now you can save some more for yourself, right? Yeah.
Exactly.
And what about the health plans too? What about those? Because so many people have these health savings accounts, and what are those kind of contribution limits, and how do those help you?
I love health savings accounts. So a lot of employers, because of the increasing cost of healthcare, a lot of employers are now going from your traditional, or at least giving you the option of having a traditional health insurance plan where you have a copay and deductibles, and but the copays are usually pretty small. And the other option is generally a health savings account where, unfortunately, the deductible is high. You need to have a high deductible health insurance account in order to health insurance plan in order to pair that with an HSA, health savings account. But what's neat about a health savings account is that when you put money in, it's tax deductible. When it's in there, you have the option to invest it so it can grow. And if you take the money out to use for qualified expenses, you don't pay tax on it. So it's really, it's almost like a retirement plan.
Yeah, it sounds like an IRA, but
yeah,
can you kind of explain how this works? How do the IRAs work so we can, understand this better?
Well, let's talk about some of the health savings account features first. And that is, so for a single person, you could put $4,150 in there. As a family, or $8,350. And if you're over age 55, you can do an additional $1,000. May not seem like much, but that account can grow over time. When you turn 65 and are eligible for Medicare, then you can, the handcuffs are off and you're free to use that money a little bit more. Now, there are certain limitations. Can't use it to pay for health insurance plans, but there is the option to be able to use it for long-term care. But to circle back on the plans themselves, a lot of people are familiar with traditional IRAs, where you put the money in and take the deduction, so you get a tax benefit up front. But when you take the money out, that's when you pay the tax.
Yeah, right.
Roth IRAs were designed to be the exact opposite. You pay tax up front on the money, so it's after-tax money. But when you take it out, it comes out tax-free. Here's the key. All things being equal, or ceteris paribus, as I was told in my Econ 101 class, if your contribution's the same, the growth rate's the same, and the tax rate is the same at the beginning and end of your measurement period, you're going to end up at the same place. So the reality is, a traditional IRA is a bet that tax rates are going to go down in the future. Whereas a Roth IRA is a bet that tax rates are going to go up in the future because you're paying tax now. And if tax rates go up, you get a greater benefit when you take the money out in a higher tax environment. Again, if taxes don't change and investment returns are the same and the money going in is the same, you're going to end up at the same spot after tax on the other end of that time period. So
that's very interesting, Doug, because there are income level restrictions for a Roth, which prevent a lot of people from being able to take advantage of it. But you and I were chatting before, and you mentioned something to me called, it's IRS approved, called the backdoor Roth. Could you explain a little bit about this? Because you don't hear people talking about this very much, and I think it would be really helpful to hear from you about this.
I'm glad you asked that. There are limitations on Roth IRAs, so it's really driven by income, whether you're single or married, filing joint. And the issue is once you hit that income level, you can't do a Roth IRA. And what's happened is a lot of people, particularly if they're participating in a qualified plan at work. So what's happened is people have developed this backdoor Roth IRA strategy. You put a make a non-deductible IRA contribution for the year, and then at some point in the future, you convert that to a Roth IRA. You're not getting the deduction up front, but you're getting the money into your Roth. Now, there's a lot of complexity around this. It sounds very simple. One complicating factor in there is if you already have a traditional IRA, then the IRS says, well, a non-deductible contribution is only non-deductible on the conversion for the prorated amount. So for example, if you have $100,000 IRA, traditional IRA, and you put your $7,000 contribution in non-deductible contribution, then try and convert it, the IRS is going to say, wait a minute, only 7% of that is on the conversion is not taxed. The other 93% is going to be subject to income tax. So it takes some planning, but it's a strategy that the IRS has acknowledged and recognized and is not going to pursue taxpayers for taking advantage of that.
Thank you. Well, this just points out the need to have one-on-one conversations with your financial planners and your people that understand your particular circumstances and can advise you appropriately. So one of the things we talk about with IRAs, I don't want to run out of time here because there's so much to talk about, but you mentioned required minimum distributions from IRAs. And I know I had this when I inherited something from my mother, and all of a sudden it was like, well, Robin, even if you don't need it, you got to take it out. So maybe you can talk a little bit about RMDs, and is there anything you can do under the Secure Act to, as a tax strategy here?
That's another great question. So, if you're over 73 right now, you probably know what RMDs or required minimum distributions are. And they really only affect traditional IRAs and traditional 401ks, those accounts where you got the tax deduction up front. Why? Well, what Congress giveth, Congress taketh away. They got to get their money back. So they're going to tax you on it, and they're going to force you to take that money out. And that's really based on the end of year account value or for your accounts, all of your accounts that are traditional, the end of year account value and your life expectancy. So it's a calculated factor, and generally the custodian will tell you how much you have to take out for that account, but they have to be aggregated. You don't have to take them all out of all the different accounts. You got to take them all. You can take them from any account you want, as long as you meet the whole number. The issue is what happens when people end up having to take more RMDs than they really need. Now they go in a higher tax bracket. Oh, and by the way, taking that income may force you to pay tax on 85% of your Social Security benefits instead of 50%. So managing those RMDs is important. Now with the Secure Act 2.0, we had some changes. So if you were, it used to be 70 and a half that you had to start taking that. If you were born before 1951, now it's up to 72. If you were born between 1951 and 59, it's 73. And if you have the fortune of being born after 1960, you can wait until age 75. But sometimes waiting that long isn't always the best strategy, because what happens is the account value builds up. You're going to end up getting taxed on it. If you die with the money in there, that's what everybody's really concerned about. Now your heirs have to pay income in respect of a decedent. They got to pay income tax and potentially estate tax on the value of that account. So it makes sense to kind of manage that in a way so that you can have that last as long as possible.
And in that spirit of giving, Doug, as we we reach the end of our show, I want to remind people about annual gifts. That for this year, you can give up to $18,000 to any one person. And if you're married, you can elect to make split gifts of up to $36,000 between taxpayer and spouse. So keep me in mind as the holiday season approaches for these wonderful gifts that you can make tax-free to deserving folks in your life. So any closing comments, Doug? These were super helpful tips, but any parting words?
Yeah, they always talk to your financial professionals, your CPA, attorney, and make sure that everybody is on the same page. Coordination amongst your advisors is critical, because they all have valuable information to provide to help you make the best decisions. And just make sure that you make smart choices about your money, because particularly about taxes, because taxes could be the highest expense that any of us pays over our lifetime.
Yeah. And as you pointed out, that Tax Cuts and Job Act is expiring at the end of 2025, but who knows? There could be all kinds of legislative changes in Congress to keep some of those provisions alive in the future. So stay in touch with your financial advisors, and we will hope to see you all back in January for a new year and a new lineup of great shows about your money.
Fantastic, Robin. And I want to thank you, and I want to thank our production staff and our viewers for supporting Money Matters TV. Our next show is going to have Jeff Watkinson of Watkinson Capital Watkinson Capital Advisors on. So we appreciate your viewership, and this is the place to go, because your money matters.